The president said, "Major combat operations have begun." He said the objective is to eliminate imminent threats. He said Iran can never have a nuclear weapon. Now pause. When a U.S. president uses words like obliterate, annihilate, massive operation, markets don't react emotionally, they react financially. And if you value breakdowns that follow the money, not the noise, subscribe and like the video. That's how Invest Legacy grows. Because while headlines focus on conflict, capital focuses on opportunity. Let's follow it. 1. Oil moves first. Whenever Middle East tensions rise, oil reacts instantly. According to the U.S. Energy Information Administration, roughly 20% of global petroleum consumption flows through the Strait of Hormuz. If that route is threatened, even rhetorically, markets price in supply risk, and supply risk pushes oil higher. If oil jumps from $75 to $100 per barrel, U.S. producers generate billions in added revenue. American exports gain leverage. Domestic drilling becomes more profitable. The United States is now one of the world's largest oil producers. That changes the power dynamic. Disrupted Iranian supply can mean higher pricing power for American energy. But here's the tension. Higher oil helps producers. It hurts consumers. Inflation risk rises. So the profit depends on where you sit. 2. Defense spending expands. The president said, "We are going to destroy their missiles. We are going to annihilate their navy." That translates to procurement. According to the Stockholm International Peace Research Institute, the U.S. already leads the world in defense spending by a wide margin. When operations escalate, budgets rarely shrink, they expand. Missile systems, naval deployments, air operations. Defense contractors often see increased order flow during sustained geopolitical tension. Markets anticipate that. Not because conflict is good, but because government spending rises when threats rise. Risk creates budgets. Budgets create revenue. 3. Strategic leverage. Zoom out. Iran exports oil to major global consumers, including China. If that supply tightens, importers compete harder elsewhere, often at higher prices. That shifts leverage towards alternative suppliers, including the United States. Geopolitics isn't just military, it's economic positioning. Energy dominance isn't a slogan, it's leverage. And leverage has financial value. 4. Political capital. Strong military rhetoric often creates what political scientists call a rally around the flag effect, short-term approval during national security events. If operations appear decisive and controlled, political capital increases. If escalation spirals, it reverses quickly. There is no verified evidence that a president personally profits financially from military action, but political capital? That's real currency, and it influences elections, policy direction, and public perception. 5. The cost. Now the part nobody likes to discuss. War is expensive. Post-9/11 conflicts cost the United States trillions over time, according to long-term federal budget analyses. Short-term oil spikes may benefit producers. Defense spending may boost specific sectors. Strategic leverage may increase. But prolonged conflict expands deficits. Markets hate sustained uncertainty. If escalation widens, oil spikes can trigger recession. Inflation can resurge. Federal debt can climb. Temporary gain can become long-term strain. The real equation. When speeches intensify, markets translate words into numbers. Oil volatility, defense contracts, bond issuance, inflation risk. War moves money, but it redistributes gain and loss unevenly. Certain sectors may benefit, but sustainable prosperity depends on stability, not escalation. At Invest Legacy, we follow incentives, because understanding where money flows is understanding power. If you want more breakdowns that cut through emotion and analyze global events through a financial lens, subscribe. In moments like this, the loudest narrative isn't always the most important one. The money is. I'll see you in the next one.